Hi, welcome. In this video, I want to give a quick overview of the statement of cash flows. As I've said earlier in an earlier video, in this course, we're going to introduce the statement of cash flows. In your next course, you're going to learn how this financial statement is prepared in its full detail. The statement of cash flows is one of the 4 required financial statements. It provides information about the cash receipts and cash disbursements of an entity. Basically, it summarizes the transactions that impacted cash that period. Now, cash includes cash, but it also includes cash equivalents. Cash equivalents are investments that are easily convertible to cash. An example is treasury bills. The statement is prepared after the income statement and the balance sheet are completed. The reason for that is that the statement can be prepared by analyzing the changes in several balances on those financial statements. You show me those 2 financial statements of any company, and I can tell you what the cash flows were related to any particular account. You'll be able to do this as well, especially after you have fully studied the statement of cash flows and mastered it. The total cash flows are inferred from income statement amounts and changes in the related balance sheet accounts. Chapter 21 is devoted exclusively to preparation of the statement of cash flows, and again, you'll examine this topic in an upcoming financial accounting and reporting course. I provide an overview in this course. So the usefulness of the statement of cash flows. Cash provided or used by operating activities is the cash analogy to the accrual accounting-based net income on the income statement. You've already prepared some income statements, so you've got an idea about what that means. Accrual accounting-based net income provides a better indicator of future cash flows in the short term than does cash from operations. When combined with net income, cash flow information provides helpful information for assessing future profitability, liquidity, and long-term solvency. In the long term, a company must be able to generate positive cash flow from its operating activities to remain solvent and to grow. Cash provided by operating activities, it can be used to pay debts, finance growth, or return cash to the shareholders in the form of dividends or the repurchase of their shares. Classifying cash flows. The cash flow statement will classify the cash flows of the company according to the 3 classic activities of the business: the operating activities, the investing activities, and the financing activities of the business. Cash provided or used by operating activities. Again, that's the cash analogy to net income. The inflows and outflows of cash that result from activities reported in the income statement, such as revenue from cash from customers, cash paid to suppliers, cash paid to employees, cash paid to for utilities. It's net income, but on a cash accounting basis. Cash inflows from operating activities include things, again, like cash received from customers for the sale of goods and services, cash interest and dividends received from investments. Cash outflows from operating activities include things like cash used to purchase inventory, cash used to pay salaries, wages, and other operating expenses, cash interest paid on debt, cash paid for taxes. These are all examples. This is not an exhaustive list by any stretch. Now, there are 2 methods for preparing the operating cash flows section. There's the direct method. In the direct method, we provide the cash accounting-based income statement. So on the income statement, you see sales revenue. On the statement of cash flows, you'll see cash received from customers. Why do those differ? Well, a lot of sales are on account. And so we make the sale in the current fiscal year, but we receive the cash in the next fiscal period. Similarly, we might have received a big payment on a sale recorded the prior year in this current fiscal year. The cash interest or dividends received. Cash paid for inventory. That differs from cost of goods sold because we expense the inventory when we sell that item. Cash paid for operating expenses. That's going to differ from accrual-based operating expenses because of all of those accruals that we did in adjusting journal entries, for example. And cash paid for taxes, again, as opposed to the taxes accrued on the current year's income. The other method for preparing the operating section of the statement of cash flows is the indirect method. Under this method, we begin with net income from the income statement, and we adjust that income for all the non-cash items included in that income. Two types of adjustments needed. Non-cash charges included in the non-operating accounts. Example of these include depreciation expense and gains and losses on the sale of fixed assets. And then the second type of adjustment that's always needed is the accruals, the changes in the operating accounts. Again, for example, that increase in accounts receivable means that less cash was received from customers than sales were recorded. An increase in accounts payable means we paid less cash for expenses than was accrued. Cash provided or used by investing activities is the second section of the statement of cash flows. It provides information about the inflows and outflows of cash related to the acquisition or disposition of long-lived assets. Cash outflows from investing activities include the purchase of long-lived assets, such as property or a factory or equipment, and purchases of investment securities, other than any investment securities classified as cash equivalents or trading securities. You'll learn more about that in an upcoming course. Cash inflows from investing activities include sale of long-lived assets or sale of those investment securities, again, other than the investments classified as cash equivalent and trading securities. Cash provided by financing activities is the third section of the statement of cash flows. It provides information about the inflows and outflows of cash related to the external financing of the company. Cash inflows from financing activities include proceeds from notes payable, loans, bonds, or mortgages. Cash investments by owners is another inflow from financing activities. This is, for example, when we issue stock and the owners buy the shares, make a capital contribution, and now own a piece of the ownership of the company. Cash outflows from financing activities include dividends paid to owners, cash used to repurchase shares of stock from owners, and repayment of any long-term debt. Now, in an upcoming video, we'll do a quick illustration of the statement of cash flows. It'll be a pretty simple one. We'll start with the direct method. And again, in this course, we just want you to become familiar with what's on the statement of cash flows and a good working knowledge of how it's prepared. You'll master it in an upcoming course. Thanks for your attention. Have a great day.